Good evening out there. Hope everyone is having a good week so far. It's going to be an eventful week, that much is for sure. We've got Fednesday as well as quadruple witching, and of course on Fednesday we actually have Vixpiration, so that just makes it all the more exciting, right? So we've got a pretty interesting navigating the markets here for everyone. And if you're not able to stay the whole time, it will be recorded and posted. But if you have any questions as we're talking here, feel free to post them. Let me know, and I'll try to get to them during the Q&A section. But before we go too far into this discussion, let's quickly get through the risk disclosure here. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. Now here's today's heat map for the S&P 500. You'll notice a bit of a theme, not as much of a bid in big tech, more of a bid into the broader S&P 500. And if we zoom out to a 1-month heat map, we actually see a very similar trend to that. We see more of a rotation into other parts of the S&P as a theme. And so this has sort of been part of a trade setup we've had, which has been long some of the high dividend payers, fading the high beta stocks, long the relative strength-driven play of looking at the equal-weighted S&P versus the market cap-weighted S&P, value versus growth. A number of different factor versus factor pair trades have worked on this basis, this broadening out. And the broadening out has reason. It's not just flows, but there's also a rotation in earnings. We're seeing more of those value sectors, more of those defensive sectors starting to see their earnings growth increase. The inglorious 493 starting to see better growth trends in earnings as they accelerate versus the Mag 7, which are seeing their earnings decelerate, albeit still very impressive earnings and revenue growth, but they are decelerating. And so that does call into question some of those lofty valuations. Now, let's move on and look at some charts here. First one we have is of SPY, the S&P 500 ETF. And we can see that it is at a key inflection point. We've been here before. We're back to this place again, albeit from a higher low. So momentum does look a little better. Typically, when you knock on these levels over and over again, eventually you do break through. So the question is this week going to be that time? Is the Fed or some of these other events we have going to be the catalyst that pushes us over this key level? We're quite close. So we're going to be watching this going into this week, see if we get a weekly close above. I think that's the most important thing here for continuation, that we close above, let's call it 563 on Friday. The triple Qs have a somewhat similar look, albeit less bullish. It's not a flat top that they're trying to break over. It's instead this descending trend line. And a lot of that has to do with the relative weakness. We talked about it in that month-over-month heat map chart, and we can see it in this chart as well. Versus the S&P, triple Qs are lagging. Big tech is lagging, and NASDAQ earnings growth is also set to lag according to analyst estimates. So they're either lowballing it again and these things are going to beat and they're going to start soaring, or we are starting to see a deceleration in broader tech and not just the Mag 7. So something to keep in mind as we go throughout the next couple of months and as we start to get into really the heart of Q3 earnings season is, are these companies able to deliver that same kind of high double-digit earnings growth, or do we start to see a deceleration in key parts of tech and especially the mega caps? And does that mean we see a broadening out of leadership as other companies in the broader market start to see their earnings growth improve? That's been my base case since mid-July. It has set up for some great pair trades that we've been in, one of which I'll highlight as we get further into this presentation. But before we do that, let's check out IWM. This is the small cap index, and I know a lot of folks are looking for continuation in the Russell. I would say the biggest thing I want to see is a break above this descending trend line. Look familiar? It looks a lot like the NASDAQ. Isn't that odd? Not exactly what one would expect here, but the NASDAQ and the Russell have a very similar look, and they're at a kind of similar inflection point here. So I'd be keeping a close eye on both IWM and triple Q to see if they can break above these sort of bearish trends. It's either a flag and we're going to break out, or we get rejected and we start to move lower. So far, we're being rejected here, but the week is by no means over. And I really do put a lot more value on the weekly close than anything else for these trades and investments that are on longer time frames. Now let's look at everyone's favorite stock, NVIDIA. Whether you love it, whether you hate it, we have to pay attention to it because it is a big market mover, whether we look at options flow or it's weighting in the major indices like the S&P 500 and the NASDAQ. And NVIDIA is at a key inflection point. The way I do my 20-day moving average is open, high, low, close. And we're looking at it just pinging around that 20-day moving average. And it's sort of in this range it's been trading in, let's say, since late May. So I'm looking, to want to get bullish on it, I need to break above the 20 then on a closing basis. And then I think we've got room to the top of the range. And then how we treat the top of the range is going to have a big impact as to whether we can get back to those all-time highs. So I'm still a little cautious here because we're consolidating. In fact, I like AMD a little bit better for the risk to reward setup here and the momentum in the stock in the near term than NVIDIA as a potential trade setup. And we'll talk about that in a moment. But first, let's get to the dollar. The US dollar is breaking lower. It's actually making new yearly lows here. There's that key level around 100.50. We just cut right through it. And we have a lot of market participants that are increasingly expecting a 50 bips cut in September and about 240 bips of cuts over the next year through next September's meeting. So part of that is weighing on the dollar because you see, the expectations for the ECB cutting less than that. You see the Bank of Japan turning about, starting to look at raising rates again. You see the Bank of England not necessarily on the same aggressive cutting path that what is priced in for the Fed. And so that is putting downward pressure on the dollar here. Another area that's putting downward pressure on the dollar is the absolute crazy rip-roaring rally in bonds. When yields drop, the dollar tends to drop too. And part of that's that presumed shrinking differential in interest rates between the United States and some of the major currency pairs. Remember, the dollar's biggest pair in the index is the euro, right? It's about 70% of the US dollar index. So kind of as goes the euro, as goes the dollar. And the euro is starting to look more constructive here. The dollar is starting to look the opposite. So it's going to be all about Fednesday. And we'll get to that a little bit later in the presentation as to what my thoughts are and what the projections are. But I will say that I think that's the key for the dollar, for interest rate markets, and to no small degree, likely for risk assets as well. Although I will preface that by saying, what happens on Wednesday typically takes the market several trading days to process. So the weekly close, again, is going to be the most important one to watch. Now let's get to silver. Silver is breaking out. I love to see what's happening here because we're finally starting to see a really bullish chart setup. You can see we've put in this higher low and higher high. We're breaking above the 20-day moving average. We just busted through a key low volume node and the descending trend line. So you have this sort of setup of many different factors showing you buyers are in favor here, and we could get back to those highs that we saw in May and June. And from there, if we can take those out to the upside, I think we can start to, again, look at silver getting back to some of those 2011 highs. I think the absolute high in 2011 was around 48 bucks. It wouldn't be too surprising to see something like that, particularly in the first half of next year, where I'm looking for gold to get to 3,000. Gold hit my target for September. That was 2,600. I started talking about that early in the summer. We're there now. I still think gold can get to 3,000 in the first half of next year. We may correct a little bit from there, but I'm still overall constructive on gold, and I'm bullish as heck on silver, seeing it break out here. We've got to respect the price action. It's telling us something here, and that means there's setups in some of these higher quality miners. You look at gold, Agnico Eagle looks good. You look at some of the streamers. For example, you can look at Wheaton Precious Metals, WPM. They look pretty good. Sandstorm looks pretty good. I should talked about these on Fox Business with Charles Payne last Friday. And then you can look in silver, and you can look at SVM, Silver Corp, right? That's one that I really like in the silver space overall, and I think that it has room to run with silver as well. So those are some to look at if they fit your setups and your investing or trading profile. Those are some that I'm long, looking at this momentum shift and what's happening with this breakout in gold to new all-time highs that we saw last week, but also silver breaking out and looking much more constructive. Now here's another commodity play. I think we've seen a near-term low in copper. And I think that some of this has some relationship to the presumption that China's government's going to stimulate. Whether they actually do or not, commensurate in the size that the market expects, remains to be seen. But nevertheless, we have to respect momentum. And momentum gives me the idea that global copper miners could be a potential play up to 48.54. So I'd be looking for that, kind of guarding risk with the 20-day moving average. It's pretty tight risk to reward. I would be a little more forgiving, maybe getting us down to this sort of low volume node here as to where I'd stop out initially, and then moving up above that 20-day moving average as we see the trade get deeper into the money. And really, I think we could get pulled into this point of control, get stuck there, consolidate a little bit, and then eventually get drawn up to 48.54 on COPEX. So this would be a play I'd look for over the next month and a half, 2 months. If copper really gets some upside, I think COPEX could outperform it to the upside, and that could give us close to 20% upside from here. We'll definitely be watching this one. Another one I like is AMD, and I like it a little more than NVIDIA right now because the way this chart is setting up looks particularly constructive to me. So I'm looking at AMD. I'm thinking, we could get to like 178, 179 from here. I'd guard risk with the 20-day moving average, but I would like to start building a position. I wouldn't want to get full position in one trading day, but I'd like to start building a position into this one and guarding risk with that 20-day moving average. We can see we've moved above that. We moved above the descending trend line, and we have this, sort of area of potential demand above us. Could we get drawn into that and start to kind of accept price in the 160s, 170s? I think so. And if we do, I think that's where it makes it much more likely that we make a push into that high 170s area. Now, one of the rotations that I really like watching here that I think is pretty darn constructive is this SPHD versus SPHB. So again, this is part of the broadening out in the market. It's also part of the rotation to more defensive positioning. So if you think about what's happening here, it's this rotation away from really high beta stocks, the more cyclical stocks, and into these high dividend paying, more defensive stocks, right? So this is sort of one of those later cycle plays where you see money managers, they have to stay long a certain component of equities. So they start rotating their positions away from the riskier parts of the market. But the other tailwind that we have here is during Fed cutting cycles, high dividend stocks tend to outperform. So not only are they more defensive in a slowing economy, not only are they benefiting from both sides of this rotation in this pair trade, but also there are some historical trends that can favor dividend stocks. And if you think about it, in a Fed cutting environment, you're looking for fixed income in other places when the risk-free areas start to dry up. So looking at high dividend stocks is one of those areas. Now, while we're watching the broader S&P 500, another area that's key is options exposure. This is options expiration week. It's a quad witching week, so we also have all these equity futures contracts expiring, like S&P, NASDAQ, Russell 2000, and Dow. We have expiration on Wednesday, same day as Fed Day, by the way, which is going to be pretty interesting. But that gives me a sense of it's really important to watch how positions roll this week. Right now, a lot of that SPX gamma exposure is below us. I'd like to, if I want to be constructive on this market, see that roll higher after OPEX and into next week. And we should see some of that rolling really take place over the next, say, 4 trading days. So I'll be watching to see if we see that rolling, that sort of bullish repositioning or not. And we are reasonably well into positive gamma territory here. So I think that's also important to keep an eye on. That means that we do have some subdued realized volatility trends intraday. We see rips sold and dips bought. So that can compress things. But do bear in mind, a mitigating factor of that is, again, it's quad witching week, which means you've got a lot of positions rolling, typically somewhat more thin liquidity. And then on the other side of that, you've got Fednesday on expiration. So you do have some volatility catalysts there. And then as we approach this sort of second half of September trading environment, seasonality also portends to weaker conditions overall for the broader markets. And that's looking back at multiple different time frames. The chart in front of us is from Equity Clock. They're looking at 20 years of trading data. This chart from Goldman Sachs goes all the way back to 1950, and it shows that the second half of September tends to be the worst second half of the year. So it at least says maybe it's a decent time to be a more conservative risk taker, to hedge out some of those longs. I don't think it means let's go wildly short the market and, hope that seasonality somehow sets up that kind of trade. I think it's more about risk management. How bullish do we want to be when we're, 2% from all-time highs? We've got some major events happening, whether it's the repositioning in the market due to OPEX and contracts expiries, or the Fed and how the implications of their decision and their guidance from the SEP as well as Powell impacts sentiment in the broader market. Another interesting chart is even daily return volatility also tends to rise in September and even more so in October. So it just tells you, you could have more days that are plus minus 2% in this environment, particularly in this back half of September and even more so going into October. So again, some degree of caution for folks if you're running leverage or if you're really, 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 really long, just look for greater volatility to potentially be part of our setup, which for me means smaller size, wider stops, and more careful trade selection. Don't overtrade this environment. Now, going into Wednesday, or Fednesday as I like to call it, currently Fed funds futures are looking for a 63% chance of a 50 bips cut. Now, the reason I'm showing these here is as we get closer to the Fed decision day, they tend to have a higher hit rate of being successful. So, it's a little bit overpriced to me. I still favor 25, but I can see the market is shifting its expectations. You can't ignore the huge rally in the twos. You can't ignore the huge rally in the tens, how much interest rates have come down. So there's two scenarios. Either the market is finally right about this after being wrong so many times before, but again, often not right on the week of the Fed decision. So that's one thing that makes this time a little different with what we're seeing in Fed funds futures. So I think overall it's worth watching how this plays out, because if the Fed comes in with 25 and a more conservative dot plot than what Fed funds futures are expecting, that could reset expectations a bit. So let's look at those expectations. The market is pricing in nearly 240 bips of cuts over the next year. I think that might be a little much unless the bottom falls out of the economy or the broader markets. Personally, I would look for less than that. Be careful what you wish for, because if you do get this, it probably means something's wrong. It doesn't mean just inflation has come back, but, come back down further. But it probably tells you that there's something even more disconcerting in the broader economy, right? So I would be more looking at this as the Fed has an opportunity to come out and kind of walk these expectations back. And if we look at the June dot plot, it was much, much less aggressive than what the market is pricing in for September. And the Fed does come out with their SEP report at this meeting, so they will be discussing their next dot plot at the press conference. Powell will probably be questioned about it even more, about their path forward and where they see rates going. I imagine he'll, sort of combat specificity with the data-driven narrative, but I also imagine that he can be a little bit more forthcoming than he was at Jackson Hole, because this is that big moment where they release those quarterly projections on the economy, inflation, and interest rates, as well as, of course, employment or unemployment trends. So overall, be careful going into this week throughout, because Wednesday, even the initial reaction where a lot of hedges may be removed, so it's generally somewhat positive in reaction, may not be the final reaction. And if the Fed comes in light, there are reasons that certain parts of the market, the more long duration rate sensitive parts, the more tech and growth centric parts, may not do as well. But on the other side of that, if you get a 50 bips cut, you could see more signs about the broader economy being part of the sort of forefront of concerns that people are thinking about. Because if you say, okay, well, we're going into this meeting, we didn't see the economy slowing as much as it has, we're going to cut 50 because we have to catch up because we missed this. That's a concern that it may not inspire confidence in market participants, who may wonder, what is the Fed seeing that they missed? And how much of it is this a concern that they're cutting this aggressively this soon? So we'll have to see how this all plays out. I think it's a very interesting week. I'm less certain about what the Fed thinks. I still lean towards 25 on the cut, but I'm less certain than I was last week that that's going to be the outcome. So recapping, markets all across the board at a key inflection point in the S&P, the NASDAQ and the Russell. I'm bullish at AMD, silver, global copper miners, and dividend-paying defensives, especially against their higher beta peers. And the market may be mispricing the Fed's cutting cycle again, really interested to see how this plays out on Wednesday. So I'm going to shift it over to questions and answers. If you have any questions for me, let me know in the chat. Yeah, Johnny Dangseed writes in the chat, I feel most of the NASDAQ's weakness is heaviness in Google, and that hasn't yet been able to break out. Yeah, I think that's a part of it as well. And I do think that there is some chance that Google can kind of complete this lower high move and then resume that downtrend from here. It really depends on what the market's expectations are, but I think the company has been slipping a bit versus its peers. Do you think gold will visit $3,000 an ounce before ending the year? Asks Gustavo. That's a good question. I am thinking that it depends a bit on the election outcome. The way that I look at gold is it's a hedge against uncertainty. And we definitely have a lot of uncertainty right now. So if that continues to be a trend, then I think gold is our friend. It's something we want to have in our portfolio. And so if this election ends up kind of going off the rails, as it could, yes, gold could easily go above 3,000 by the end of the year. So that would be the major catalyst. The other catalyst for gold is the aggressiveness of the Fed and other central banks cutting cycle, right? If they start to go heavy, like the Fed does 50 and other central banks start to lean in more, I think that would be a catalyst for gold, silver, and probably crypto as well, and a lot of long duration risk. And then finally, geopolitical tensions, right? If they continue to escalate in the Middle East and in Eastern Europe, that's another potential catalyst for precious metals and to a lesser extent, potentially oil as well. All right, folks. Well, I want to thank you all for tuning in. It's always a blast. Hopefully this was helpful for your trading process and navigating the markets for the week ahead. And if you have any questions at all, let me know. I'm always happy to help. I'll catch you soon.